Okay, so um, in this video I'll be looking at how we can navigate through price using daily range theory, and I'm going to use gold as the case study. Gold currently on the monthly chart. So I'm going to look at what transpired this past week in this video, and then how we can use daily range theory to navigate through price, and then develop logical arguments towards our bias, and how the PDRAs will support price from one level to the other. So starting on the monthly time frame, what I always like to do first is to determine the direction in which we'll be going, or the bias, because without the bias you could make bad decisions which would affect your trades. And so starting on the monthly, this is what I see. We have this monthly fair value gap, which would like to see support price, and then indeed it has. See how it has pushed price up. And so from here, this monthly fair value gap, it's evidence that we'll be moving here up. So internal to external range liquidity, simple as that. And then you define your bias. So going into the weekly, this is what I found. So going into the weekly, good. So inside the weekly time frame, you see that within, prior to this being formed, this monstrous bullish candle, inside of that monthly fair value gap is a tiny fair value gap right here. Let me make it bigger so that it becomes clearer. Yeah, good. So there is this tiny weekly fair value gap embedded inside of the monthly, and so to mark that out, and then clone that, and then we see how price traded into that. So I'll take away this monthly fair value gap, good, and then focus on just this weekly fair value gap, which is rather more significant to what I'm going to do today's video, right? And so inside of this we have that, then price trades down, disrespects this fair value gap, right? Disrespects this weekly fair value gap, and then runs into this weekly fair value gap. Great. And so going into the daily, this is it. Going into the daily, you see that this high has taken liquidity to the left, and then over here this low has taken liquidity to the left as well. And so we can pick up this, mark my range from the high to the low, and then we realize that if we had kept the fair value gap, the monthly fair value gap, it would have fallen within the 50% of the range, and then this weekly fair value gap is just within discount, just below the 50% and in discount of the dealing range, of the current dealing range. And so when price trades into this key level, at the 50% and forms this low, our dealing range could now become this high to this low, because still we have swept buy side liquidity here, swept sell side liquidity here, and then here, then into this monthly fair value gap, same as the weekly fair value gap, at a key level in the dealing range, which is the 50%. And so we can go into the 4-hour and then see the range for ourselves. And then because we are anticipating that price would go up, we would expect that bearish PDRs are what disrespected. So now our PDR becomes our dealing range becomes here to there, and this is how it played out over the week. So looking at this price action, so from this high to this low, we see that we have run into this key level, rejected, formed a low here. So we've marked up dealing range, and then if you look at it carefully, closely, I mean, you can see this, that we have the sell side of the curve of the market maker buy model. This is the market maker buy model. So we have the sell side of the curve, and so because we are looking for what do you call it, bullish price action, we know that we are going to form the buy side of the curve. Then this is the buy side of the curve. I'm trying to get it properly here. Good. It's coming together. Let's see. Yeah. And so we are supposed to get a buy side of the curve, and then when we look at this place, right, price runs into this, moves up, leaves a tiny fair value gap right here. Let me enlarge that so that it's evident. Yeah. So price runs into the key level, the fair value gap, runs above this, disrespects this tiny fair value gap right here, creates a fair value gap, runs above this bearish candle, which becomes a bullish order block. Then price moves into it, pushes up, leaves a bullish fair value gap, then goes up. And then right here, what we would have anticipated is that this bearish fair value gap on the 4-hour, if we were supposed to go down, would have actually pushed price down. But because we are in a bullish market, yeah, I just want to enlarge it so that it becomes clearer. Yeah, good. So this is the whole picture. Great. Because we are in a bullish market, we disrespected this fair value gap, run above it, closing above this candle, this bearish candle. And then when you look at this 1, 2, 3, 4, 5, all these candles become what? A bullish order block, because we've run above them and then closed above, and then they form at the 25D RT level with this inverted fair value gap inside of it. And so if price should have retraced back into this place, what would have anticipated is that it would have held price and then moved up. And then when we look at this place, you see it reaches exactly at the top of this candle before over here. Let me mark that out over there so that it becomes clear. Exactly. So just at the tip of this candle, and then it moves up. Why? Because we have a low, a high, a lower low. Then we break above these candles, which become what? A breaker, right? Breaker block. And so from there we hit that, and then we moved, we continued, and then we disrespected the fair value gap at the 50% as well. So once we disrespected this fair value gap at the 50%, we should anticipate that this will also become what? An inverse fair value gap, which would act as support to push price up. And if we should mark this out to see, Look at how price trades through it, leaves this breakaway gap, moves away, and then price finds support exactly at the 50% of this inverse fair value gap, right? Before it pushes up, disrespecting the fair value gap. And actually, I got into a trade at this place, right? Exactly at the top of this. But in the one, I was looking at this in the 1 hour, and I was thinking maybe it wouldn't work out because of the choppiness which was occurring at this place. I was thinking probably price would dump a bit, and so I got out of the trade only to regret it later because price moved this much, right? So back to the 4 hour to explain things a bit more, right? Let me bring this down a bit so that I capture the whole frame. Good. Yeah, that's nice. And so we disrespected this fair value gap, and at the 50% we found support over here, and then we continued. And then if you look at this also, this was a fair value gap we marked on the weekly, right, which was inverted to the down, was supposed to be bullish, inverted to the down, right? Left this fair value gap inside of it, resisted price to the down into the bullish fair value gap on the weekly time frame before we started having this. And then when we look at that fair value gap again, once it got here, because we are inside of a bullish market, it got disrespected. And look at the 50% of that inverse fair value gap on the weekly, right? It now does what? Serves as support. We break through it, and at exactly at the 50% again, see what happens. Find support. No candle closes below it once it was breached exactly at 50%, and then we see price what? Pushing up. And so here we have the sell side of the market maker, X model. This is the buy X model, and then we are forming the buy side of the curve. So this is the sell side of the curve, and now we are having the buy side of the curve. And so now we know that we have these relatively equal highs at this place. We have this swing high over here, and then we have the high of that range, which is not impossible for us to reach. And so going into the lower time frames, right? See how beautiful this is. Going into the lower time frames, we could, whatever entry model you use, you could find a fair value gap. You find an order block, a breaker block on the lower time frames, and then you get yourself into a trade to at least this place. Or if you want to target the high of the range, that if price reaches there, then that's fine. Okay, and so that is it. And then you can see exactly this was the high of the breaker. See how we touched it, just touched it, and then we run above, going, and price hasn't. See on the 1 hour, the 50%. See how we pushed up. And so a fair value gap or any PDRA, which your favorite PDRA you like to enter on, and then we move, targeting higher prices with this one. And so when we are in a bullish market, or when we are in a one-sided market, we expect that let's say when we are in a bullish market, we expect that the bearish PDRAs would be what? Disrespected, so that it falls in place with what the higher time frame narrative is. So lower time frame PDRAs would have to follow the higher time frame narrative. So if you are looking for we are in a bullish market, we are anticipating that the bearish PDRAs would fail and then act as support, right? So if you're in a bullish market, bearish PDRAs will fail and act as support for price to move up, like we've seen with this this weekly inverse fair value gap and this one as well. And then inside of this, we see that this 4-hour fair value gap, we could even reduce it on the 1 hour to this fair value gap. Now let me try that, and then let's see how price also supported it over here. See, so the moment we disrespect it just a touch right here on the 50%, and then we rally again, right? So that is how we can use um, you know dealing range to navigate through price and not necessarily waiting for uh, internal to external or anything like that. So once you have your bias fixed and then you know where price is going, you can just go into the lower time frame before all of these prints. Before all of these prints, you know you are inside of a weekly fair value gap. We are going up, and so you can mark your buy side liquidity, right? So here, this low resistance liquidity rate right here. So let me use the trend, this signature low resistance liquidity rate right here. So you could have targeted that, and then now we are going for those relatively equal highs I already mentioned on the 4 hour over here. You see that? You see this area? So this should act as a magnet and pull price towards it, so that price clears that. You see? So in a bullish market, bearish PDRs will fail, and then they will act as support to aid the higher time frame idea of bullishness, in this case for gold. Right, so this is exactly what I wanted to explain with this video, how we can navigate through price using dealing range theory.